Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at HIMS and HERS Health.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So today is going to be a bit of a therapy session for anyone looking at the healthcare sector. We are looking at HIMS and HERS Health, and honestly, if you purely look at the share price lately, you might think this company is on the brink of disaster.
Oh, it is ugly. I pulled up the chart right before we started, and it's just a sea of red.
Yeah, it really is.
We're talking a 47% drop in the last month and year to date.
Right.
It's trading around $15.50. If I didn't know any better, I'd assume they missed earnings, or the CEO quit, or the FDA shut them down.
That is the logical assumption, Usually price tells the story, but then you open the 2025 financial analysis and it feels like you're reading a report from a completely different company.
Totally.
It's arguably the most confusing disconnect in the entire market right now.
Let's unpack that disconnect, because the numbers are, frankly, startling given the stock performance. We are looking at the full year 2025 revenue hitting $2.35 billion.
$2.35 billion. Just pause on that for a second.
It's a massive number.
It is massive. But the context is what really matters here. That represents a 59% increase year over year.
Wow.
In the current economic climate, finding a consumer-facing company doing over $1 billion in revenue that is still growing at nearly 60%, that is a unicorn.
Yeah, absolutely.
Most companies are celebrating if they hit, 15 or 20% growth at that scale.
And they didn't slow down at the end of the year either. Q4 of 2025 alone saw $618 million in revenue. That's up 28%. But here's my skepticism, and I think this is what the market is worried about. Usually when I see 59% growth, I assume it's fake growth.
What do you mean?
I assume they are spending $2 in marketing just to make $1 back.
Yeah.
Is this just a cash-burning machine disguised as a growth company?
See, that was the bear case in 2021. That was the knock on HIMS back when they went public via SPAC. But that argument is dead in the water now.
Okay.
This is the profitability pivot we have been waiting for. They have turned a very significant corner. Net income for the year reached $128 million.
So that's JAP profitability.
Yeah.
Actual money in the bank.
Real profit.
Yeah.
And if you prefer adjusted EBITDA to look at the operational health, that came in at $318 million.
That's substantial.
It is. That is a 14% margin. And crucially, that margin is expanding. It's up nearly 2 points from the previous year. So to answer your question, no, they aren't burning cash to grow.
Right.
They are actually getting more efficient the bigger they get. That is the holy grail of software and platform businesses.
And just to put a bow on the financials, they beat expectations on the bottom line too. Q4 earnings per share came in at 8 cents, crushing the expected 5 cents.
Yeah.
So let's recap the good column for you listening. Revenue is skyrocketing, they are profitable, margins are expanding, and they're beating analyst estimates.
Correct.
Which brings us back to the giant elephant in the room. Why on earth is the stock down 47%?
Right.
If the business is on fire, in a good way, why is the stock in the toilet? Is the market broken, or are we missing something obvious here?
It's the classic disconnect, and that is really our mission today, to figure out if this is a value trap or the buying opportunity of the year for you. To do that, we have to look under the hood at why they are growing.
Okay, let's look.
Because selling generic erectile dysfunction pills, which is how most people still think of HIMS, doesn't get you to $2 billion in revenue this fast.
Right, the blue pill business. That's steady, but it's not explosive.
Exactly. The explosion is coming from two specific engines that have really fired up in the last 12 to 18 months. The first, and the most publicized, is obviously the weight loss segment.
This is the GLP-1 craze, the Ozempics and Wegovy's.
But with a twist. HIMS isn't just reselling the brand name drugs because nobody can get them. There are shortages everywhere. HIMS pivoted to offering compounded GLP-1s.
Explain that distinction, because I think that's where the regulatory fear comes from later.
So when a drug is on the FDA shortage list, pharmacies are allowed to make compounded versions, basically generic copies, to meet demand.
Got it.
HIMS launched their compounded weight loss program, and the uptake was instantaneous. Within just 7 months of launching, that segment hit a $100 million revenue run rate.
7 months to hit $100 million? That feels, dangerously fast.
It is ludicrous speed, but it speaks to the pent-up demand. People are desperate for these medications, insurance isn't covering them for everyone, and the brand names are out of stock. HIMS stepped in with a solution that was accessible and affordable. They tapped into a gold mine.
Okay, so engine one is weight loss.
But I feel like that's the risky engine. It feels precarious. What's the second engine?
This is the one that I think is being severely undervalued by the market, the international boom.
Okay.
For a long time, HIMS was purely a U.S. story. But in 2025, international revenues surged nearly 400%.
400%. That's hard to wrap my head around. Scaling healthcare internationally is a nightmare. You have different regulations in every single country. You can't just flip a switch like you can with software.
Which is why it's so impressive that 400% growth brings international revenue to $134 million. They are aggressively expanding into complex markets like Australia and Japan.
That's huge.
And if you listen to the chatter around the earnings calls, the leadership has put a flag in the ground. They want to push international revenue to over $1 billion in the next 3 years. That is bold. They basically want to build a second company the size of their current U.S. business just in international markets.
Precisely. And that diversification is key. If the U.S. market slows down, or if regulations change here, they have this massive growth engine spinning up overseas.
But let's play devil's advocate for a second. Growth is great, but in telehealth, the churn is usually terrible. I sign up, I get my prescription, and then I cancel and go buy it cheaper somewhere else.
Sure.
Or I get cured and I leave. How sticky are these customers really?
The data is surprising here. Their total subscriber base is now over 2.5 million people, but the metric that really matters is revenue per subscriber.
Right, the ARPU.
Exactly. If people were churning and burning or downgrading to cheaper options, that number would drop. Instead, monthly revenue per subscriber actually rose 11% to $83.
$83 a month is a significant subscription. That's not a $5 streaming service. That's a utility bill.
It is. And the fact that it's rising means they are cross-selling. A customer might come in for hair loss, realize the platform works, and then add a skincare regimen or a mental health anxiety treatment. They are stacking services.
This leads us to the business model debate. Because the bears, the people selling the stock, they argue that HIMS is just a middleman. They say it's just a fancy website for doctors to write scripts.
I've heard that.
But you argue there is an actual moat here. What makes HIMS different from a standard telehealth provider?
It's the direct-to-consumer, or DTC, model versus the B2B model. A traditional telehealth company's customer is the insurance company. They have to beg insurance companies for contracts. HIMS goes straight to you.
They bypass the insurance middleman entirely.
Exactly. Cash up front. But the deeper moat is the personalization we touched on. Because they are leaning into compounded medications, mixing specific ingredients for dermatology or mental health, the treatment is personalized to the patient.
Right.
You can't just take your HIMS prescription bottle to a local pharmacy and say, refill this. The pharmacy doesn't have that formulation.
So it creates a lock-in. High switching costs. If I find a hair loss blend that works perfectly for me, I'm physically unable to get it elsewhere. I'm stuck with HIMS, happily or unhappily.
Stuck is a harsh word, but yes, you are retained. And that retention prints money. We mentioned the profits earlier, but look at the cash flow. In 2025, they generated $300 million in operating cash flow. They are free cash flow positive.
In this interest rate environment, that is your safety net. If you have cash, you control your destiny.
Completely.
If you need to borrow money right now, you're in trouble. HIMS is sitting on a mountain of their own cash.
And they are deploying it. They aren't just letting it sit there. They are reinvesting in technology. They are launching new specialties. And there's even talk of potential M&A mergers and acquisitions to accelerate growth. Plus, look at the gross margins.
What are they?
75%.
75% is software territory. That's what you expect from a massive tech giant, not a healthcare services company.
It confirms that at its core, HIMS is a technology platform that sells healthcare, not a healthcare provider that has a website. There is a distinction.
Okay. We have spent the last few minutes painting a picture of a perfect company. Revenue up, profits up, cash flow positive, margins huge, international exploding.
Yeah.
So why is my screen red? Why is the stock down 47%? We have to look at the bear case. Why is the market terrified?
It really boils down to three things: guidance, technicals, and regulation. Let's start with the immediate trigger, the guidance jitters.
The market didn't like the forecast.
The market is incredibly short-term focused. Management gave full year 2026 guidance of $2.7 to $2.9 billion. That is solid.
Right.
But the Q1 2026 guidance, the immediate next 3 months, was viewed as soft.
So because they might grow slightly slower for 90 days, investors dump the stock.
Essentially, it creates a disconnect between short-term expectations and long-term reality.
Mm-hmm.
But when you combine that with the technicals, it gets ugly. The stock has a beta of 4.8.
4.8. That is insanely volatile.
For context, a beta of 1 means you move with the market. A beta of 4.8 means if the S&P drops 1%, HIMS might drop 5%. It's a high-octane stock.
It amplifies the panic.
Exactly. So when sentiment turns slightly sour, the sell-off gets exaggerated. But looking at the technicals now, the stock is oversold. The RSI Relative Strength Index is sitting at 16.58.
Explain that for the non-traders listening.
RSI measures momentum. Anything under 30 is considered oversold, meaning the selling has likely exhausted itself. 16 is incredibly low.
So it's hit rock bottom.
It suggests the rubber band has been stretched as far as it can go to the downside. It's deep value territory.
So technically it looks like a bottom, but the fundamental risk is the one that keeps me up at night, the regulatory risk on the weight loss drugs.
This is the big one, and we have to be honest about it. The FDA allows compounding of GLP-1s because the brand names are on the shortage list. If the major pharmaceutical companies suddenly fix their supply chains and the shortage is officially declared over, the legal loophole for compounding closes.
And that $100 million revenue stream we talked about earlier, poof, gone.
It wouldn't disappear overnight, but it would face significant legal challenges. They might have to stop selling the compounded version. That is the fear driving the stock down. Investors are saying, what if the government shuts off the weight loss tap?
It's a valid fear. If I'm holding the stock, that's a binary risk I don't like.
It is valid, but this is where the diversification argument comes back to save them. Remember that international growth, 400%.
Yep.
And remember the core business hair loss, sexual health, dermatology, those are huge, profitable, and have nothing to do with the GLP-1 shortage regulations.
They stand on their own.
So even in the worst-case scenario where U.S. weight loss takes a hit, HIMS is not going to zero. They're a diversified, profitable machine. The market is pricing them as if they are a one-trick pony, and they simply aren't anymore.
So you're saying the market has over-indexed on the weight loss risk and ignored the international success.
That is exactly what is happening.
All right, let's move to the verdict. We've looked at the good, the bad, and the ugly. The stock is at $15.50. The PE ratio price to earnings is around 28.72. Is that cheap?
For a company growing revenue at 15 to 24%, which is the projection for 26 paying 28 times earnings, is actually quite cheap.
Really?
Usually you pay a much higher premium for that kind of growth. It's near a 2-year low in terms of valuation.
It feels like a clearance sale, but you have to be willing to stomach the volatility. So what are the catalysts? What is going to turn this ship around?
We have a few things on the calendar. First, keep an eye on May 2026. That's when the Q1 earnings results drop. Remember, the stock tanked because of that soft guidance. The bar is set low now. $659 million in revenue is expected.
So it's a setup. If they beat that low bar,
if they beat that and show that the growth story is still intact, the stock could rebound sharply. It's the classic under-promise, over-deliver setup. Management might have sandbagged the guidance just to set up an easy beat.
and what about the macro trends?
This is counterintuitive, but the dropping price of GLP-1 drugs actually helps HIMS. Prices are down about 80% globally in some contexts.
Wait, doesn't that hurt their margins?
You might think that, but it actually helps their volume. It makes the compounded alternatives the go-to option for the millions of people who can't get insurance coverage. It normalizes paying out of pocket for these meds.
Which is HIM's entire business model. Cash pay.
Exactly. Cheaper prices mean a bigger total addressable market.
All right, it is time for the Smart Wealth Score. Taking all of this into account, the massive growth, the profitability, the scary regulatory risk, and the beaten down price, where do you land on HIMS and HERS?
I am giving this a bullish score of 8 out of 10.
8 out of 10. That is high confidence given the risks.
It is. My thesis is simple. The sell-off is a massive overreaction. When you have a company that is profitable, sitting on $300 million in cash, growing at double digits, and trading at a 2-year low valuation, the risk-reward ratio is heavily skewed in your favor.
And the strategy. This isn't a day trade, is it?
No, absolutely not. With that beta of 4.8, you will get chopped up if you try to day trade this. This is a multi-year hold. You are buying the entry point at $15, which I believe offers a psychological floor. You hold while they execute on that international expansion and navigate the weight loss landscape.
You're betting on the management team to keep executing the way they have been.
I'm betting on the numbers, and the numbers say this company is fundamentally stronger than the stock price suggests.
It's a compelling argument, a potential diamond in the rough, hidden behind a very scary stock chart. But before we wrap up, I want to leave you listening with one final thought. Something to chew on that we haven't fully explored.
What's that?
We talked about the retail investors panicking. We talked about the stock dropping. But if you look at the ownership structure, 96% of HIMS and HERS is owned by institutions. 96%.
That is an incredibly high number for a so-called risky stock.
Exactly. The big money, the hedge funds, the pension funds, the endowments, they own almost the entire company. And despite this drop, they are staying put. They aren't selling. They are holding.
Right.
So the question for you listening is, do you have the patience to wait for the rebound, just like the big money's doing? Or are you going to let the volatility scare you out of a high-growth opportunity?
It's the hardest part of investing, doing nothing when everyone else is freaking out.
Absolutely. The disconnect between the institutional confidence and the retail fear is palpable here. That is all for today's talk on HIMS and HERS. We hope this helps you navigate the noise and make a smarter decision.
Thanks for listening, everyone.
See you next time on Smart Wealth with Joshua.